Rubik's Cube might be difficult. This is even harder. Brian is talking about those Brexit negotiations getting underway today. British government taking some warning from business leaders, Brian, and leaning perhaps a little bit further towards a soft Brexit.
Yeah, it will be tricky. It's Brexit Minister David Davis due in Brussels today to get down to brass tacks with EU negotiator Michel Barnier. As we saw earlier, some tense words between the two parties in the press last week. That, along with an apparent lack of political unity on the UK side, making British businesses rather nervous. The Confederation of British Industry releasing a survey over the weekend showing that 42% of UK companies say Brexit has hurt their investment plans. UK Finance Minister Philip Hammond has been an advocate for the so-called soft Brexit, with the UK prioritizing trade ties with the EU over hardline immigration curbs. He says that the government is coming around to the need for interim trade agreements as Brexit proceeds. Let's take a listen.
The way to get the economy moving, the way to restore business confidence and then consumer confidence is to give as much clarity as possible, as early as possible, which is why I have been talking over the last 4 or 5 weeks about the importance of a transition arrangement. And I believe the great majority of my colleagues now recognise that that is the right and sensible way to go.
Philip Hammond there. I'm going to talk about Greece now on the programme. The government has started to take some tentative steps to rejoin the international capital markets.
Well, Greece got a vote of confidence from Europe last week when the European Commission recommended an end to disciplinary procedures over excessive budget deficit concerns. That was widely seen as a prelude to Greece rejoining the bond markets. Since crisis hit in 2009, Greece has issued only 2 government bonds, those in 2014. It's expected to make some new moves in the coming days, as Claire Rush reports.
A crucial test for Athens, and good news for the Eurozone. 7 years after the Greek economy nearly collapsed, and 3 bailouts later, Greece is planning an imminent test of the bond market. Last week, EU reports were positive.
It's not my role to make a prognosis on the day, the week, the months when Greece will regain market access. But obviously, this is the next step, and this perspective is becoming more credible.
Last month in June, Eurozone creditors moved to help Greece's return to the markets when they unlocked the latest tranche of Greece's bailout funds. The loan of 8.5 billion euros was to help Athens repay its 7 billion euro debt that was due in July. A remarkable turnaround from just 2 years ago, when Greece defaulted on the IMF's 1.5 billion euro loan. Since then, it's been good news for Prime Minister Alexis Tsipras. Credit rating agency Moody's raised Greece's long-term issuer rating from stable to positive. After a 6-year recession, GDP rose 0.4%, and Brussels ended its disciplinary procedures over excessive deficit. The far-left Syriza government is considering swapping a 3-year bond issued in 2014 with a new 5-year bond, yielding between 4% and 5%, a move that would help Greece reduce its financing needs for 2019. A timid first step, but it could help pave the way for Greece's return to the markets in 2018, when its bailout program will expire.
Claire Rush there. Markets then, Brian, how are they looking?
Well, European shares opening higher as we start the new trading week. Investors looking ahead to those Brexit talks today. British broadcaster ITV getting a new CEO as EasyJet's Carolyn McCall moves over into the job. ITV seeing a bump on the FTSE 100. Asian markets mixed, mainland China indexes, including the Shanghai Composite, falling after a major financial policy meeting over the weekend, suggest the government is planning to increase control over the country's economy. Korea's Kospi index up around 0.4 despite a dip in Hyundai shares, with workers there planning to go on strike soon. The Tokyo Stock Exchange is closed Monday for a holiday. Let's take a look at some more of today's top business headlines. The Chinese economy grew by 6.9% between April and June. Those second quarter results put GDP growth well above the government's 6.5% target. 2016 saw China's economy grow at its slowest pace in 26 years, but a raft of data released Monday, including industrial output and retail spending, show growth picking up speed. And Wells Fargo is preparing to eliminate a number of its smaller business operations, according to the Financial Times. The plan comes after the U.S. lender announced it would pay $142 million to settle a class action lawsuit over the creation of unauthorized accounts and credit lines for unwitting customers. So far, Wells has made deals to sell its registration business and its commercial insurance operation.
And finally from Brian, the US labour market. It's looking pretty healthy these days, but there are just some troubling factors at play. Play is the crucial word.
The working rate among young American men has been steadily declining over the past 20 years. According to a new study released by Princeton University, total market hours worked by men between the ages of 21 and 30 fell by 12% between 2000 and 2015. The rate of young men not either working or in school full-time doubled over a similar period to 15%, both of those figures far greater than for older men. The study, however, posits an interesting explanation. It could be video games. The researchers say that, quote, innovations in gaming/recreational computing could explain as much as 79% of the difference in work rates between younger and older men. And perhaps most troubling, but maybe least surprising, those who spent more time in virtual worlds than in the real one reported increased overall happiness.
We're very happy here, aren't we? Are we in a virtual world?
It
could
depends
be.
on which side you're watching from, I suppose.
We're sort of in a virtual world.